Hey there, everyone. Welcome back to our channel. If you're new here, I'm your name, and today we're diving into a topic that can significantly impact your finances: capital gains. Specifically, we'll break down the difference between short-term and long-term capital gains. So, whether you're an investor, a homeowner, or just curious about how taxes work, you're in the right place. Now, you might be wondering, what exactly is a capital gain, and why does it matter? Great question. Simply put, a capital gain is the profit you make when you sell an asset for more than what you paid for it. But what distinguishes short-term capital gains from long-term ones? Stick around, and let's explore. First up, let's clarify what short-term capital gains are. Short-term capital gains occur when you sell an asset that you've held for 1 year or less. These might include stocks, bonds, or real estate. The key here is the holding period. If you sell it within a year, you're looking at short-term gains. For example, let's say you bought 10 shares of Company A for $50 each, totaling $500. If you sell those shares just 6 months later for $70 each, you now have $700. That's a profit of $200, which is your short-term capital gain. Now, here's the catch. This gain is taxed at your ordinary income tax rate, which can be significantly higher than the capital gains tax rate. In the United States, for instance, ordinary income tax rates can range from 10% to 37%, depending on your total income. So, that $200 gain could be taxed at a higher rate than you might expect. On the flip side, we have long-term capital gains. These apply to assets that you've held for more than 1 year before selling. The tax rates for long-term capital gains are generally much more favorable. Let's go back to our example. If you held onto those 10 shares of Company A for, say, 14 months before selling them for the same $700, your $200 gain would be considered a long-term capital gain. In this case, you would pay taxes on that gain at a long-term capital gains tax rate, which is typically 0%, 15%, or 20%, depending on your income level. To put it into perspective, let's consider the tax implications. If your income puts you in the 15% long-term capital gains tax bracket, you would only pay $30 on that $200 gain. That's a savings of $170 compared to the short-term gain scenario. This is why many investors aim to hold onto their investments for longer than a year. Now, let's look at a real-life example to see how this plays out in practice. Imagine you're an investor who buys a rental property. You purchase the property for $300,000 and sell it after just 10 months for $350,000. That's a short-term capital gain of $50,000, taxed at your ordinary income rate. However, if you decide to hold that property for 2 years before selling it, and you sell it for the same price, your $50,000 gain would be classified as a long-term capital gain. Depending on your income, you could save a substantial amount in taxes. Now, it's essential to consider other factors as well. Holding onto investments for the long term can also provide you with additional benefits, such as potential appreciation in value, dividends, or interest over time. Plus, you might avoid the stress of frequent trading and market fluctuations. Another important point to note is that the IRS has specific rules and exceptions regarding capital gains. For instance, the primary residence exclusion allows you to exclude up to $250,000 of capital gains on the sale of your primary home if you meet certain conditions. If you're married and file jointly, that exclusion goes up to $500,000. This is particularly beneficial for homeowners looking to sell. In summary, understanding the difference between short-term and long-term capital gains can help you make more informed investment decisions and save money on taxes. Short-term gains are taxed at higher ordinary income rates, while long-term gains enjoy lower tax rates, which can significantly affect your overall financial health. So, next time you consider selling an asset, take a moment to think about how long you've held it and how it might impact your tax burden. Keep those investments in mind for the long run, and you could be reaping the rewards. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe for more educational content. Also, feel free to drop your questions or experiences in the comments below. We'd love to hear from you. Until next time, happy investing!